Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is December 12th, 2024, and today on our call we have the CEO, Joe Walewicz from Neupath Health. Neupath trades on the TSX Venture Exchange under the symbol NPTH. The company is currently trading at 19 cents with about 56 million shares outstanding, or about $11 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Joe, welcome. Glad to have you here.
Thank you.
We've actually spoken, I think, probably about 3-4 months ago, initially to get a slight idea on what you guys are all about. But we've got you here so we can get a much better understanding of what Neupath is all about, and obviously have our membership learn about the company as well. So welcome. You've got a presentation deck ready to go, so I'm just going to hand it over to you.
Perfect. Yeah, thanks. And I'll just go through our normal corporate deck today, and it'll be up on our website for anyone who misses that. So I'll put that up later today or tomorrow morning. So thank you, Paul, Trevor, for inviting me out to present to you guys. First, just wanted to give a quick intro to myself. Joe Walewicz, I'm CEO. I took over as CEO about a little over 2.5 years ago, I guess. But I've been on the board for more than 4 years now. The company prepared its RTO in 2020. And so I've been on the board since then. First, audit committee, and then as the company had some challenges about 2.5 years ago, the board, we all looked around at each other and thought who could step in at that critical juncture. So I'll give you a kind of quick overview of that. Briefly on Neupath, and then I'll dive in. We're a medical facilities company running medical facilities that treat patients with chronic pain. We have a strong financial position and consistent growth, organic growth and inorganic growth. You'll see that. And more importantly, faster EBITDA growth. So we've been improving our margins, which we think will drive investments in the business and allow us to, which will, of course, lead to future growth. But more importantly, the big changes we've had on the balance sheet will allow us to add on the inorganic side and serve more patients and more with more services and more locations. So I'll just keep going here, and please, we'll have questions at the end. We're obviously public, so we will make forward-looking statements. You can have a look at that in our annual filings on SEDAR, which we were just joking about beforehand. And then finally, we do use non-IFRS measures, such as adjusted EBITDA, and you can have a look at those, and all those are reconciled within all our financial statements. So just a quick overview of Neupath. Revenues are tracking around 70 million a year right now, if you look on a trailing 12 months basis. We have about 200,000 patient visits a year. So this is a large operation. We're operating 12 clinics in 2 provinces. We have 165 healthcare professionals and over 250 people if you add our physician partners and our employees. 15,000 physicians referring into our network for their patients. And so that's something we'll talk about in a little bit as being a little different from, say, a normal clinics business. And I just want to highlight a couple things. So people automatically assume when we're running clinics that this is a private business. We are actually a private provider of public health. And so we're Canada's largest provider of chronic pain services in supportive and complementary to the public system. And what I mean by that is that when you go to a clinic in Ontario or in Alberta, this is largely covered by Alberta Health or the OHIP system in Ontario. So this is a public pay system. It's not a private pay business. The business now tracking, I said, over 70 million. We've been adjusted EBITDA positive for 23 straight quarters, cash positive since I took over the business. And really, the goal here since I took over and new CFO 2.5 years ago is operational improvements to just make this, really focus on doing, I like to say, just do one thing well. And that's what we've been trying to do, is focus on our core clinics business. Lots of opportunities for growth. We have not fully saturated the pain market in Ontario. We have not fully saturated the pain market in Alberta, and we're not in any other provinces. And then beyond that, there are so many adjacent services relating to chronic pain we're very comfortable with our opportunities for growth. But more importantly, I want to add here the provincial and federal government initiatives. If you look at what and you listen to what governments are saying, everyone around the world, not just Canada, is talking about doing less in hospital and more in the community, and that's kind of what we do. And so when they talk about private, private surgery centers, that's what we do. We do private facilities that are doing procedures that used to be done in hospital and now being done in the community. And then finally, I'll talk about valuation. We did mention earlier that market cap a little over $1 million. We're tracking well over 3 million adjusted EBITDA. We'll obviously report year-end results in the first quarter, but for now, you can have a look at our trailing 12 months numbers and get a good sense of where we're at there. This is a current graphic of our network. Our core clinics business, which is more than 95% of revenue, operates under 4 banners: Neupath Center for Pain and Spine, InMedic, HealthPoint, and HealthPoint at CAO. And as you can see from the map, we're covering most of Ontario, Ottawa to Windsor, and pretty much everywhere in the middle. I'm not in Kingston, not in Sudbury, not in Niagara, so those are clearly markets I'm not yet in Ontario. And then Alberta, where we through a 2021 acquisition entered the Edmonton market, bought a business called HealthPoint. Then we signed a partnership with a group in Red Deer and built a new clinic there in 22, and that opened really the end of 22, really taking off in 23 and now in 24. So that's kind of the sense of where we're at. We also, there's a little footnote on there. So we own 10% of 2 physiotherapy clinics in the Edmonton area. Not something that we are managing or growing right now, but they do refer into our business, and they're a great partner for us for our Edmonton business. So I talk about chronic pain. I use this slide not to talk about these $1 billion, because I know every CEO talks about these mega $1 billion markets that they're serving. But actually, more importantly, we all know chronic pain. Everyone probably on this call knows someone who's suffering or has suffered from chronic pain. It's a big cost to the system, and because, as you know, this is a problem with the presenteeism. People who are in chronic pain are stuck, chronic lower back pain, unable to move, unable to get to work. But there's also, what I really want to focus on here is not so much the burden of the system, but also just the adjacencies. I've told you earlier that we have not saturated the chronic pain market. There's lots of more work we can do in sports medicine, concussion, spinal injuries. There are things related to what we do in that core market that we think give us many years of growth. So what happens when you go to a clinic and you go to one of our clinics? So first and foremost, all our 12 clinics have variations of what each, based on which physicians are present, what procedures they're doing. But this is the reason I put this laundry list up is to sort of intro our next slide and just talk about different things. If you have fibromyalgia, you may be getting an infusion at one of our clinics. If you have chronic lower back pain, you may be going in for what we call radio frequency ablation, where they stick needles in and around the spine and ablate the nerve endings. If you have chronic headaches, you have migraines, you may get a Botox injection. If you have things like, if you have other injuries such as, I was thinking of, what am I thinking of here? Sorry. Like scoliosis or shoulder and arm pain, you might get an injection of PRP, what we call, that's platelet-rich plasma, and so that will help the healing process there. So when you look at all these things, you've heard almost every procedure I mentioned to you involved a needle, and I think that's why I sometimes use clinics, but really we operate medical facilities, and I'll go into that on the next slide. With our clinics, these are regulated facilities, and that's the core difference between, say, a pure clinics business that some other providers in Canada that offer. And a medical clinic, where you're sitting, where I'm sitting, is a doctor's office. If you were a doctor or I'm a doctor, you cannot do chronic pain medicine in that clinic. And that's because when you're injecting needles in and around the spine, there are infection control procedures, there's air quality procedures that are required, there's specialized equipment. Things like we have in this, for example, is our HealthPoint facility in Edmonton. And we have 3 fluoroscopy suites there. Now, fluoroscopy is a fancy word for real-time X-ray. So why would you do that? Well, back to my discussion around needles. If someone is placing a RF needle around your spine, you really want the doctor to know exactly where that is. And so that's kind of, again, this whole idea of these are regulated facilities using modern technology. But more importantly, if you think about it, we have this referral network, we have this just that basic piece. So bullet 4 is really what every other clinic business does. All the other 3 things are really important for what we do. And that's why I kind of mentioned earlier a little bit about kind of out of hospital surgery. These are regulated facilities. And just to finalize that point, what we do in our clinics, like this Health Point facility you see on the picture in front of you, you can do in a hospital. There's no reason you need to come to our clinic. If you want to drive downtown, pay $40 for parking and get stuck in traffic, you can do that and wait 2 years on the 2-year wait list for the UHN in downtown Toronto. So I think the idea here that we operate regulated facilities in the community where patients can actually get those treatments that they need. And for doctors, this is really valuable. We have all these things that they can recreate. They can do the facilities, they can borrow money from the bank to build these, to get the equipment. But it's the combination of all of these that we believe is a real differentiator and is one of the reasons why we see such low turnover in our network. So I mentioned, kind of broadly, avenues for growth. One thing we've really been focused on for the last 2 years since and previously as well is capacity utilization. We have a lot of space that we can better use in our clinics. How do we better use that? Well, bringing on new doctors, obviously, most obvious, adding new services. We're constantly evaluating and adding new services in our clinics. And then finally, just improving the output, throughput, using our, we have an X amount of doctor time in a day. How do we efficiently move patients in and out of the clinic? That's a core focus for us. Second, obviously we can grow the business by expanding, and we expanded to Red Deer with a new greenfield. We expanded to Edmonton with a new acquisition. So partnerships and acquisitions also can lead us to new locations. Finally, orthopedics and other specialties have a huge overlap. Basically, if you're referred for surgery and they say you're not eligible for surgery, there's a good chance you are a candidate for chronic pain management services. And conversely, if you're not being well served by chronic pain treatment services, there's a good chance you might need surgery. So these are kind of great fit. And that's why I think we've seen in particular, our Red Deer clinic take off so well, as just having that orthopedics and interventional pain co-located in a facility is a great learning for us. And I think we'd love to do more of that as we go. Finally, I do mention that out of hospital surgery, a fluoroscopy suite with slightly better HVAC is basically could be a surgical suite. And so we kind of note that, we note the government interest there. We're not expanding there now, but we definitely feel that down the road, that could be an area, avenue for growth. So like I said, if I ever saturate my my chronic pain franchise in all of the provinces, I do feel there's a lot of other areas we can go. So just a quick overview. Last year we obviously don't have this year's numbers yet, but I think that I wanted to kind of maybe use this to highlight a little bit in 22 and why I and the board decided to step in. We had margin problems. The business was growing and the margins were shrinking, and with that, our cash balance was shrinking as well. And so the board made the strategic decision and I made the decision to step in and really stabilize the business. And you can see what's happened since then. Margins have improved substantially, and you see that with our year-to-date numbers as well. And it's really been a focus on the core clinics ops. In 2022, we were investing heavily in software development. We had a marketing team in support of software. There were a number of missed deadlines on the software program, as well as an unclear monetization strategy. So the board said, okay, let's just do one thing well. Let's do clinics well. So on the next slide, just kind of give you, where I view we are today. The business is growing. We didn't make any acquisitions, or no material acquisitions this year. We're up 9%. That's almost all organic. We're expanding in our existing markets and into new markets is expected to accentuate that growth. Capacity utilization, you saw we've made dramatic improvements in our capacity utilization over the last 2 years. You're seeing that 74% for the 9 months this year versus 67 last year. This is just running more business through smaller footprint. Finally, our adjusted EBITDA is increasing. We're up 20% year to date versus 9% top line growth, and that's what you love to see. So We're expanding margins, expanding our EBITDA faster than we're expanding our top line. So this is all allowing us to invest in growth of the business. You know, I'd be remiss if I didn't talk about the balance sheet. So balance sheet also improving dramatically, and you can see that on the next slide. Oh, I apologize if you can hear me. My slide deck is now frozen. Hello there.
No worries. We'll see if we can get it back up.
Yep, no worries. Let me just see if I can get that. All right. Can you see that now? Not yet.
No, don't have it up yet. No.
There we go. All right, sorry about that, everyone. Okay, so on the balance sheet, which is what I really want to talk to you about, is also substantial improvement. When I took over, we finished 2022 with about $1.5 million of cash, now $3 million. Our debt has shrunk over that time by more than 10%. Our net debt by 50%, and adjusted EBITDA improved, and you can see those continuous improvements this year as well. So last year, revenue's up 6%. Adjusted EBITDA 41%. Year to date, revenue's up 9%, adjusted EBITDA up 20%. So really just paying attention to the core operating business has led to a number of improvements on the balance sheet. I also want to just make one comment. We did have a kind of a big win in 23. We've been fighting the CRA for many years, who wanted to tax our doctors to come to work. They wanted us to charge them HST to use our clinics. We told them that doesn't make any sense, and it took us a number of years to finally show them that we actually operate facilities and hire doctors to work in them. And so once we were successful in that, we were able to recover a substantial win from the CRA and get back over $2 million. And as well, we sold one of our clinics last year as well, so that we're really now lease only. All our clinics are operating leases, and we don't own any facilities. So I mentioned briefly that I stepped in 22 to turn this around. I've been almost 30 years now in healthcare, mostly on the biopharma side. My last company, Clementi Pharmaceuticals, joined that pre-IPO, did a $138 million NASDAQ offering, a secondary $70 million secondary, and then sold for $1 billion in 2019. So that was after that was when the Neupath people approached me and said, "Do you want to join the board?" Jeff, our CFO, he's been with the company since pre-RTO in 2020. He was previously the controller, great experience in the business, but more importantly, he was doing such a good job that when our prior CFO left, we asked him to step up, and he's been doing a tremendous job in helping me sort out these operations and continuous operational improvements. On the board, I have Dan, and Dan are both biotech CEOs running companies that have developed products for pain management. Sasha has been very successful in the healthcare real estate space. The combination of pain therapy and healthcare real estate has been incredibly valuable for me as I manage this business when I go to the board. Bloom Burton & Co., my biggest shareholder, 32% of the stock, even more on a fully diluted basis. They took this company, built it up, RTO'd it back in 2020, and have stayed with us the whole time, and a very supportive shareholder throughout all this. And that leads me to my next slide. So you can see, I do describe here the kind of the ownership of the shares. Just to be clear, that it looks like we have 66% free float. That's actually not true. We have I have two brokers actually three brokers really, and then one of my doctors and his brother together own a big chunk of stock, and then you have 12% owned by Claret Investment Management Montreal. So really, with 5 phone calls, I get to about 80% of my shares, which is really tightly held. So it does look a little bit more liquid than it is, and so that's certainly something is top of mind, and why we're spending more time getting out there, meeting new investors, so that we don't have all the same people at the table all the time. So anyway, just to give you a sense of that, it is a little misleading on this, just how tightly held we are. Options and warrants less than 10%, or options RSUs less than 10% of the business. Warrants outstanding, those come from pre-RTO warrants that are exercisable mainly. There's 4.5 million approximately at 25 cents. The options, although we did say there's over 4 million options out, most of them, or a big chunk of them, are out of the money, as you've seen our stock price over the last few years. So finally, just to kind of give you the key takeaways, and then I'll open it up for you to take questions. Like, this is a great business. We've been growing, EBITDA positive, and really a niche business treating this chronic pain. But as you all know, for the sufferers, people suffering with this, it's not niche at all. Our investments that we made in 22, we built out some new facilities and built our new Red Deer clinic. This year, we built out our new Mississauga clinic. All of these are to better serve our patients, but will also allow for higher growth in the future. I do want to repeat, lots of avenues for growth. We don't think we've tapped out anywhere near. I think there's lots of, with improving balance sheet and improving cost of capital, we'll be able to execute on further growth. And then just finally, just background of the overall healthcare environment. Provincial and federal governments want to do more out of hospital in the community. That's where we live. That's our bread and butter. And so we think we're well positioned to capitalize on that. And so with that, I will just briefly, we do EBITDA and adjusted EBITDA reconciliations. You can see that in our quarterly financial statements. And I think that's our last slide. I'll turn it back to you, Paul.
Perfect. Thanks so much, Joe. Wonderful. Listen, one of the first questions that sort of come to mind right now is this is a blurry sort of industry in private and public, as you mentioned, and absolutely we're seeing more hospital care that's coming outside of the hospital, so to speak. But how do you describe the competitive landscape, though? Like, who are you kind of competing against to try to get your patients?
Sure. Well, I think that overall, when you look at this, the number one competitor is there are a lot of smaller operators. So when we look at, like, for example, in Ontario, we would be at best maybe 20 to 25%. We're the largest provider there. So there's definitely a lot of, so when we compete in Ontario for this chronic pain management, it would be, the direct competition would be, one, the big academic centers. So for example, UHN, there's the DeGroote Center at MAC, there's University of Ottawa has a big center there. So that you do have all the academic institutions, and then you have all the, individual, I don't want to call them mom and pop because it's not really the case, but, like individual operators or small clinics. There's a clinics group, in Kitchener, Scarborough, and Kitchener, Scarborough, Oshawa. So, just a small 3-clinic chain, one larger clinic in North York. So there's a couple of groups out there that have good sized operations. And there's one in Kingston that would be the size of our Edmonton clinic, which is our single biggest clinic, right? So there are like operators out there, and all of them draw from all over. Like, there's definitely because there's such a shortage of this kind of care and so many people in need, they all have wait lists. Like, we have wait lists. Like Edmonton, we have 12 to 18-month wait lists, right? In Ontario, it's between 2 weeks and 3 months, depending on which clinic you'd like to get into. So we all have the same problem, is that there are more people out there that need our services than we have an ability to take care of. So hence my interest in capacity utilization and efficiency, and how do you better use the resource that we have, and the scarce resource is doctors, right? If I can get 15 minutes extra into a doctor's day, that's a few extra patients that get treated. So, it's important.
Yeah. Well, let's talk about the M&A opportunities, because you guys have done that in the past. And I mean, you sold one of your facilities, you said. What does that landscape look like? And like, what typically are you buying opportunities for?
Yeah, so what we're looking for, it's buy versus build, right? Like, because look, we built, we bought in Edmonton, we built in Red Deer, right? And so there's different ways to do this. And I wouldn't say that one is better than the other. Because at the end of the day, what you're trying to do is you're pulling on new doctors and trying to serve more patients. And so if that best way to do it, with HealthPoint, that gave us that Alberta footprint, which, it may be that we expand across the province in more of a greenfield sort of fashion. If I was to enter BC, for example, or Quebec, I might have to make an acquisition first. I would be less likely to kind of build something from scratch. Sorry. So yeah, it's that's kind of how I look at it from a from an expansion profile.
Mhm.
And you can see that all that growth that we've had is really with a smaller footprint. So you did mention that we didn't really sell a business, we sold a building. So we had the
Right,
clinic
right.
in London. We had two clinics that were located about 5 kilometers apart.
Mhm.
One was 4,000 square feet in 15,000 square feet of empty space. One was an owned building 5 kilometers away. So you move the one into that empty space and you build up your capacity utilization because now that
Mhm.
empty space is now being used. So
Sure.
it was kind of, and we liberated about 2 million in capital because we had a $2 million building. We had a $1.2 million mortgage on it. And so from that, we were able to
Mhm.
just kind of, it's just these little things that you just kind of, that you're trying to solve.
Mhm.
And I apologize. I see questions coming through, so I'm going to let you guide me through them.
Oh yeah, don't worry about the questions. I'll get to them in a few minutes. I've got my own questions I'm going to try to go through
Yeah. Okay.
first.
Good.
So then when you do look at sort of the buy versus build, what kind of ROI makes that decision? Like what what does one of these look like on an ROI basis?
Well, I'd say that the buy versus build thing is really driven by, number one is the multiples, and for sure
Mhm.
we're looking at the multiples, 4 to 5 times sort of a slow grower, and if there's certain technology, like if it's fluoroscopy and we need it in that location, then we might pay a little more.
Mhm.
But again, like with you saw as well with our, one of the things we think about is when we look at our valuation, we're always trying to think of, ultimately, if I'm buying clinics at a higher multiple than we're trading at, it kind of becomes a little bit, it becomes dilutive, right? So we have to
Mhm.
kind of focus a little bit there, and that's kind of how we look at it. So that's where the build comes in a little more interesting. Look at Red Deer, for example. We built that from scratch.
Mhm.
Um, let's call it the partners put in about $1 million, let's call it, and we're already tracking over 3 million revenue, and we just opened it a year and a half ago. So it's
Mhm.
kind of it's that ROI I think will be very, very good. But
Mhm.
when it comes to a new buy, ultimately what you're buying is 4 walls and a couple of doctors. And so the
Mhm.
critical piece is that they stay. And so when we bought HealthPoint in Edmonton, where there were 23 physicians, so it's our single biggest facility.
Mhm.
Edmonton would be, let's call it ballpark 12 million revenue, right? Out of our 70. So it's a big operation. And with 23 physicians, 25,000 square feet, it's a big location, right? And from that perspective, we were able to a couple things. One, the selling shareholders had equity stakes in Neupath and earnouts and things that you'd like to build into it so that people stay engaged. But
Mhm.
even then, when we bought it, I think the day after we bought it, a few of the doctors left and they moved to
Mhm.
another city. And so the good news is we grew through it, right? Like you didn't even notice it on our top line.
Mhm.
But geez, would I have liked that they stayed? Absolutely. And so I think that we would like to we'd like to kind of focus on that a little bit as we buy these things. So you're not just buying, you're really trying to figure out how do you engage these
Mhm.
people. And that's why I think our build out in Red Deer has been so successful, is because we're 50-50 partners with
Mhm.
the doctors. And so when the cash calls start coming in, they have two options: write a check or go downstairs and work. And so then
Right.
they made at first they wrote a check, and then they quickly learned that they wanted to go downstairs and work. And so it
Right.
was, there's an alignment there that you get, that if you just buy something like I mean, I've evaluated a business where I know the guy wants to sell and he wants to spend more time in Florida. That's
Mhm.
great, but when you're looking at a multiple, you're still buying something that doesn't exist anymore,
Right.
right?
Yeah. Yeah.
Especially if
Fair
that
point.
individual, for example, is 40% of revenue, right?
Yeah.
So, you kind of have to, and then, doctors, of course, there's a little bit of, as you would expect with any entrepreneur, anyone who builds a business, there's always this, the expectation and value piece that sometimes,
Sure.
you're trying to bridge. So
Yeah.
I'd say that because it's more of a people thing, I'm not buying a factory that's making widgets. I'm
Yeah.
buying a business and I want the people to stay.
Yeah.
It's a little more soft. And so when you just say, well, what's the multiple you pay? Well, that doesn't really cover the full spectrum, but we're trying
Mhm.
to be good partners. And I think that the success of our HealthPoint acquisition has been great because when they talk to other doctors, say, hey, and they say, hey, how did that go? They're like, we love working with those guys, right? And so it's been helpful with some of our discussions that are ongoing.
Fantastic. So I usually ask the question to CEOs, what challenges you face, kind of what keeps you up at night. But I'm hearing the challenge is doctors. It's staffing, making sure you've got the right doctors in place. Is there anything else over and above that sort of keeps you up at night?
Well, we are still, as Alberta Health and OHIP are still more than 90% of our revenues, right? So, we're still subject to government, the whims and frenzies and the elections of things. We haven't had anything recently. We had a small change to our business about a year and a half ago, and we grew right through that. So there's no, it's one of those things that we always have to pay attention to is the regulatory environment. That's, the regulatory environment, new doctors. And I'd say, staff has not been as much of a challenge. People always say, well, nurses, everyone knows nurses are short, medical professionals, radiation technologists are very short in supply and they're hard to get. So those are all challenges. But I think the one thing that helps us in that is we deliver a hospital-like environment on a Monday to Friday, 9 to 5, which is a huge deal because my daughter works at Princess Margaret in downtown Toronto. And last night when I saw her, she just finished her 12-hour shift from 7 p.m. to 7 a.m. There will be a time when 7 p.m. to 7 a.m. isn't that attractive to her. And a 9 to 5 would be more interesting. And so, I kind of put that as, I do think that the reason we retain people pretty well is the fact that we offer a better workplace environment. Do you want to drive downtown Toronto or do you want to drive to Brampton, a few blocks from your house, right? So I think that does help us. So I haven't seen that staff. The one that we do have challenges, I would say that other than doctors, radiation technologists, very hard to find. Very hard to find. And they know it. And boy, do they milk you for it. Like they are, radiation technology they're not graduating them as quickly as the system soaking them up.
Right. Well, that'd be something for the young people that's listening right now. There's big opportunities in that field.
No, I would tell any kid, going into if they're going into college and they're thinking, I want to go into, nursing or rad tech. Rad tech is the place right now.
Exactly. Yeah, that might change. You're right. Let's talk about new initiatives. Is there anything that's sort of on the slate right now that gets you excited as far as any kind of either new geography, new services, anything like that gets you excited?
Well, for sure, we've talked a bit about in the past about I mentioned briefly, earlier about prolotherapy and PRP. PRP, plasma-rich protein injections. If anyone follows sports, you see an athlete, they blow a shoulder or they run into a wall. I think Aaron Judge last year ran into a wall and bumped his toe and he went for PRP injections. It's kind of like these athletes. So we do a lot, we do a fair amount of sports medicine, and PRP is something we've been rolling out to more and more clinics. The way we look at it is I say that we're a private provider of public health, but if the government won't pay for it, we're willing to offer it if the patient wants it, right? So to speak, philosophically. And so I think that what we'd like to do is add more and more things that the government says, I don't want to or can't pay for it, but the patient wants it. And we're like, well, why are we not offering that? Because what I have is ultimately, if you look at it, I have a network of 12 clinics that are regulated facilities with 100 physicians on our roster and, nurses and MOAs and radiation technologists. There are so many things we can do with that network that we haven't fully tapped. So I'd say that when we look at certainly, some of these private pay procedures, not because we want to do private pay, but because the government doesn't want to offer them and people want them, we're trying to satisfy that need. And if you look at our Edmonton clinic, for example, we do a little more of that sports medicine. The founder there, Dorin Nadeau, he's the Oilers team physician. He's the chief medical officer, the CFL. So he's big. So when I come in there and the Grey Cup's coming up, I'm like, so how do you think the Elks are going to do? And he's like, he'll talk on and on about, so it's kind of funny. So he's a rabid sports enthusiast in addition to being a great doctor. So, and you go to my clinic you go there, you talk about the Oilers. You get, so I have to. being from the East here, I have to cheer for the Oilers.
Exactly.
But
Well,
don't tell my Toronto
last year they
friends.
did
Anyway.
well, so maybe we'll play
Yeah,
them.
so no, I think certainly, but I made a long story,
Yeah.
but basically, we talk about new procedures, definitely like to add more into the sports medicine and kind of some of these therapies that people want to look at, whether there's some wellness things that we could do. There's, we added,
Right.
we started doing ketamine. We do infusions for lidocaine. We got approval to do ketamine infusions, not for, for some of the other providers out there who are doing it for neurological or for psychological disorders. We do it for chronic pain, and the dose is different, but we have a facility that can do that. So we can do infusions, we can do injections, and that once you say that that's what you do, suddenly the envelope of things you can do becomes much larger.
Joe, if you had more capital, what would you do differently right now?
Well, I think I would be more aggressive in expanding new provinces. I think that there are certainly other provinces we'd like to be in, and other locations. We'd start looking at Northern Ontario, Kingston, Calgary. Those are all places I would love to be, and I think that that's we have to be more measured. I can't hire a doctor in Calgary if I don't have a clinic. I can't build a clinic if I don't have a doctor. So we're trying to find the right way to do that, so to speak. So those are the situations, that kind of things that I'd like to, if I had some capital, you might take a break-even risk, knowing that you could pull in people, because once we do know that we can pull people in. We're at recruiting. So there's definitely that kind of thing that we're thinking about. I wouldn't, we're definitely, Canada, I think, is still our world right now. We're not looking anywhere outside that per se.
And now, mentioning the capital for sort of new facilities or growing up facilities, but as far as capital allocation, I notice you're buying back stock right now. So you clearly, management and the board thinks the stock's cheap enough to buy it back. How do we think about that? The mix between growth and buying back your stock because it's cheap. How should an investor look at that, do you think?
Well, I think first and foremost is that, if you look at NCIB, many companies just have that in place. For us in particular, given our liquidity, it doesn't really, there's not like a lot excessive opportunity to invest in our own shares. I think the message, you can do it, you can return capital to shareholders in different ways. That's one way to do it. But I think that, we're just very confident with where the business was not cash flow positive when I took it over 2 years ago, right? It was, margins were declining. We were investing heavily in new startups and in new technology. Now that our clinic operations are humming along and producing, we feel a little better about that. I think that, so when you talk about capital allocation, one is, of course, returning capital to shareholders. Two, we're thinking about, just debt versus equity. With 3 million net debt is about 3 million, versus, adjusted EBITDA. We did over 3 million last year, tracking higher this year. So when you think about that, we feel like our debt levels are very comfortable, at 3 million cash, 6 million debt. And so, we're very comfortable with kind of where the balance sheet is. I don't think I would want to, lever up too much. So I think we have an ability to speak to banks now and talk about things like, different types of mechanisms that will give us a little bit more ability to kind of execute on some transactions. But right now, I think we have enough to tuck in and build outs on our own.
Gotcha. Perfect. Okay, listen, let's take some questions from the audience. I've got a number that are lined up here. Nolan asks, he says, 2 questions, please. Does the EBITDA margin at 4.8% have room to improve more?
Well, so the short answer is yes. And so that's a good question, because, when you look at the business, first and foremost, you'll see that already this year we're well over 5, and it just keeps creeping up, right? And one of the challenges we have is that if you look at the business, there's, and you can look at our quarterly results, you'll see a real estate table, right? And you realize that there's a business here that has, when I took over, was over 92,000 square feet. And we were doing, if I look at my Southern Ontario clinics, which are brand new, are doing about $1,700 a square feet. And the rest of Ontario is doing $400 a square feet, right? And the reason is that there's just this historical piece. And so although we RTO'd in 2020, pieces of this business are decades old, right? And so there was, in the 2010s, the business went private. It was a publicly traded company, went private, and we had infusion clinics, which we sold to McKesson, and we had pharmacies, which we sold to one of the pharmacy chains, and we sold, physio clinics, and we sold that. And what was left was this pain management business, but all the real estate of those other appendages were thrown onto that. And so when I say I have high confidence of margins, we always say to the investor group, I think we say publicly about 8 to 10% we think is a normal run rate on our current $70 million base. If we were at 100 million, well, that could creep higher, just on the basis of kind of the corporate overhead. But I think the existing, revenue run rate, we think 8 to 10 is about right. It just, it takes time to work through some of those real estate adjustments, right? And that's one. And that if you look at our quarterly results, you'll see that all those leases are expiring next year. So I mentioned to you that London was very empty, and that comes up in June of next year. That I had, we closed down Toronto in December of last year. We relocated Hamilton in October this year. And so we're doing, mucking around the edges. Now we're probably at the point where a lot of that, because all those changes happen, that's all now next year. And so 2026 is the first year you'll see kind of that cleaned up real estate portfolio, right? So that's why I'm confident that you'll see this continuous operational improvements. We're of course, getting better deals with our medical supplies and managing those better. We are looking at our staffing models, and we had our HR team look at kind of what our staff is doing now, and we were able to say, like, of the 42 tasks that a nurse does in a day, only 6 required a nursing degree, right? And so then you kind of say, okay, well, what's the right ratio of nurses to clinical assistants? And so we kind of we're constantly readjusting the network. So that's why I think that everyone's like looking for that big inflection. No, that's not going to happen that way. It's just going to be this constant creep as the real estate pieces roll over, as we change the staffing model in the various clinics, as we implement new technologies to help doctors have a little more time in the day, and you see that efficiency piece start flowing through. So I'd say that we're working towards that.
Excellent. Very interesting. Wow. Okay, so the next question is, what debt to EBITDA level would you be comfortable getting to for M&A opportunities?
I would say, I would say that not that much higher than where we're at. I think we're definitely, I would like to, ultimately, I'd love to be able to use, debt and equity equally as over time. And so I think that it really depends on the cash generation part of what we're looking at too. If it's a lower margin business and I have to turn it around, then that's different. My debt comfort is different. So I don't know if I have a right answer on that one right now. Just to say that we would, I think given that, we went through a rather difficult time, and I think you saw that April of 23, we did a debenture deal. I bought 10% of that debenture deal because no one else wanted to buy it. And so, I had to support backstop it myself and the chairman. So, I think that having gone through that difficult phase, we're going to be more measured in how we do that until we kind of see the cap. So for exciting opportunity, I'd look at it differently. And, we're looking at bringing on a good bank partner to kind of work with us on those.
Fair enough. Perfect. Okay, so next set of questions here from Sean. We've got, is it clearly more economical and easier for specialists to join Neupath rather than opening their own clinic?
So it's a funny one, because if you look at all of these things, you look at Well Health, for example, and they, what they charge their doctors to join the network, and you go, well, geez, isn't it cheaper for a doctor to do this? And then when you layer in the rent and the hiring of the staff, and then buying all the technology pieces and all the other things, but in addition, that's just a doctor's office where you have rent and staff and technology. We also have the regulatory burden, right? So if I want to open a new clinic, like we moved our Mississauga clinic. It took us a couple months to build that out. I think we started construction in January. We opened August 1 in our new location. And after a couple $100,000 renos, right? That you wouldn't have to do for a doctor's office. Like, you just don't, because you don't have the air quality, you don't have the lead in the walls that we need for, these things. So it is truly different. And in fact, the overhead that doctors, I think the best way to think about it, it's a good question, is that if it was cheaper for them to do it themselves, why do we have so little turnover? Right. And I think that's probably, I think the answer is that when you go back and you look at the numbers, it's pretty hard to recreate this profitably. And then those that do, that say, well, it's cheaper for me to do it, but they're at night, they're not with their kids because
Yeah.
they're doing all their books by themselves and spending time with their accountants and, having to, talk to HR about firing somebody and, doing all these things that we do for them. So there's definitely, I think that because there's an added regulatory burden in what we do, it's, and when you look at our overheads, you can see that what we charge for overhead is actually kind of remarkable because it's almost the same as what the family practice type people do. It's this kind of ballpark 70-30 piece. And we're providing a regulated facility, and the family doctor is just basically an office.
Yeah. Yeah, no, it sounds more and more that a lot of it is a sort of a lifestyle decision. They don't have the headaches. They can check out and not worry about it when they're home with their family.
I know because I talk to these guys all the time, my competitors, and they're like, I'm just so sick of doing this now, right?
Yeah.
So they once they have to get to that point that I'm sick of doing this, that they start to figure out that the dollars, really don't, it doesn't add up.
Doesn't math out. Exactly.
There is an efficiency piece to it, right? Remember that even if a doctor runs a clinic, like if I have a clinic like for example, if you have if you have 2 doctors in the clinic, you need a nurse. If you have 4 doctors in the clinic, you need a nurse, right? So there's that micro economy of scale that a doctor will figure out, I think, as they do this over time.
Yeah. Yeah, no, for sure.
Some of them love it. So to be clear, some of them love it. And so they're not doing it to save money. They're doing it because they like it.
Yeah. No,
or they don't charge themselves overhead and they charge all the other docs over.
Okay, next question. What does patient growth look like in the future on a high level?
Well, it's an interesting one because the demographic for sure, there's an aging population piece which feeds into this. And as long as we have that trend there, you're going to see more and more of that. Definitely the types of things that drive this chronic pain. Look, if you think about why are Oshawa and Windsor our best clinics, right? Think about the demographic of the people in that in those environments. In Ottawa, all the ex-military, it's
right.
There is definitely a workplace type thing, and so with construction, with labor, we think that this. I'm not worried about this patient supply drying up unless there's some magical cure for back pain that someone hasn't come up with yet. So I think that we're in a good spot, and I think that the other thing is just never mind the aging population piece. Is that I don't know how old you are, Paul, but I'm 55, and I play squash and I ride my bike, and shit, if my shoulder hurts, I kind of want somebody to fix it, right?
Sure.
And I think people are staying active longer into their old age. So I think that it's a societal thing that older people want to be more. Call myself the older guy. The old people want to be more active, and they want to do stuff, and our parents, and our grandparents didn't do that. So I think you're going to see, I think I'm very comfortable with where we're at in terms of that niche growing and expanding, and then just, expanding beyond that core chronic pain niche.
Yeah, it's hard to imagine it's shrinking. I certainly feel the aches and pains as I get older, that's for sure. Okay, does Neupath have debentures? You mentioned debentures. Does Neupath have debentures to be settled in the coming years? If so, how much, when, and what is the plan to settle that debt?
Yeah, so the debt, we have a 1.453 million in debentures that we raised in April of 23. If I'd known I was going to beat the CRA, 6 weeks later, I probably wouldn't have done that debenture deal. But anyway, all that to say is that we did that debenture deal. There were 2-year debentures. So in May, I think May 2nd or May 3rd of this year, those will be due. And because as we have 3 million on the balance sheet, I'm not too worried about that. But we'll look at that when it comes up and then decide what we want to do with it. I mean, I feel like given our cost of equity is so crappy, we'll probably always have debt on our balance sheet until we, when I got bank prime plus, there's not a lot of interest in, so we'll probably look at banks if we want to keep the leverage on the sheet.
Fair enough. Okay, are you a takeover target with your low valuation? Anybody knocking on your door?
Well, I guess, as a public company, what I say is that, what does I like to say? Good companies are bought, not sold. My job is run a good company. And so that's what I'm trying to do here. And so we'll just keep doing that. I'm going to focus on that.
And if it happens, it happens. Yeah. Okay. So what type of synergy opportunities exist with 200,000 plus patients annually?
That's a really good question because, it's really good. We're only starting to think about this, right? In greater detail. I think there was a myopia on the chronic pain patient, but for sure, people coming in our clinics, they have diabetes. They have physiotherapy needs. They have, we have one of our clinics. I mentioned we have 10% share in physio clinic, which shares space with us in Edmonton. We have two of our doctors doing acupuncture in Ottawa, and I have an acupuncturist who comes in once a week in is it Oshawa? Yeah, Oshawa. We have availability for our patients for nutritionists. We have there's opportunity psychology. All these if you think of, I think the question is really talking about share of wallet, and I think that there is no one who has yet really spent the time to analyze, acquisition cost of a patient and what is the, if I get a referral, those 15,000 docs who are referring into us, how many of those get converted into treatment? And if we lose them, where do they end up? And what other things, if they come into my clinic and, 40% of their care is done elsewhere, what things can I bring in? So we're just starting to spend time on that. So I think that the answer to that is that there are a lot of things that our patients have comorbidities. Like pain is not a disease. Pain is a symptom of something else. And so the question is, how do I get to the bottom of it? How do I find some other things that will help alleviate it? Sometimes you can't cure pain, but you can help them along their journey. And so I think definitely psychology, some of these mental health, definitely physio, definitely a whole bunch of things that we can add into this. So we're doing a lot of work on that now, but I wouldn't say we've cracked that nut. But I think we're underestimating that opportunity, and I think that's a good one for you to highlight.
Interesting. Okay, next question. How much can we expect lease commitments to decrease in the next 2 years in lease footprint and dollars? You sort of touched on that earlier. Maybe
Yeah, I don't think we can provide guidance on the dollar piece, but what I can say is that roughly speaking, that 90,000+ square feet that we had at the end of 2023, sorry, will probably be in 26 be about 70-ish, roughly.
Okay.
So, just great example, Mississauga, we moved in August 1. Mississauga was 17,000 square feet of clinic and our head office. That it is now 4,000 square feet with a 2,000 square foot head office. So we dropped 11,000 August 1. That's not a wishful thinking. It's not a analysis that may happen. It actually happened. And that will, start as you look at Q4, because Q4 will be the first full quarter of that. And as you look at next year, that'll start saving us money. Now, we did have a sublease revenue there. So that's why, when we clear, Well Health was a subtenant of ours, for example. And we had, a pharmacy, sorry, for rest of Canada, Shoppers. We had a Shoppers, sharing some space there. So we had a physio clinic there. So we had subtenants, but it was still mostly empty. So that sort of flows through. So what we're noticing with the landlords, if the bigger picture question is, are they cutting rents? And the answer is no, they're not cutting rents. What they're doing, for example, Mississauga, we get 9 months free rent. They gave us $120,000 in inducements. So you're seeing the tenant TIs for a space they're giving decent amount of a tenant improvement allowance, which is great for us to build newer, nicer facilities for the next stage, which I talked earlier about some of that private pay stuff. We want our facilities, give them a little, spruce them up, give them a little nicer look and feel, so that the private pay patient feels comfortable in that setting. So I'd say that the opportunity on that is definitely, we're going to be downsizing. It will definitely save money on the rent and the cash flows, for sure. The per square foot will not go down as quickly as our square footage will go down. But we're going to use that opportunity to upgrade facilities. So Mississauga, our new Mississauga clinic looks fantastic. We got 2 new fluoro suites there. Got doctors starting fluoro as soon as we get that approved. So definitely happy with the way we're interacting with landlords.
And then so can you add specialists as you're seeing a decline in the lease footprint?
So the short answer is yeah. So
Yeah.
I mean, I shouldn't say that everywhere. So we actually will be probably expanding in one of our clinics. I won't name it right now, but one of our clinics will be expanding a little bit. Like it's 2,000 square foot. We're going to add another 1,300 square feet because it's too busy, right? It's one of these over 100% capacity utilization clinics. Another one of my clinics, my Brampton clinic, is over 100% capacity utilization. So definitely have to think about what we're going to do with space there. So we might expand that a little bit. But your question was adding specialists. So if I'm over 100% capacity, then I can't add someone. Someone says I want to work Wednesday in Brampton, I can't allow them. So I never want to be at 100% capacity utilization, even though financially you do. You never want to because your recruiting suffers.
Right.
In Edmonton, we had a new doctor join us in July, a new grad from U of A. So, you know, that's helpful for there. So we're a new specialist coming out of U of A. So we have room across the network to add in almost every location. Just some places a little more tricky. Like we have people doing Saturdays now in Brampton. So we do Saturdays and evenings because it's too busy.
Yeah.
You know, whereas like other clinics, you know, I might be able to add person on a Tuesday, you know, for example.
Right.
So
Right.
we definitely have a new specialist join us started in August in Ottawa, you know. So we're adding through, you know, we're adding in the locations that have the space.
Okay. Okay, good. Okay, so Paulo asks, do you know Level Jump? Are they a competitor or / potential acquisition?
I apologize.
There's a company called Level Jump. I can't remember, a publicly listed company. I'm not super familiar with it, but I do know it exists. My guess is you don't know it. So,
well, I guess by the look on my face, you can see.
yeah.
I apologize. No, I'm not aware of Level Jump.
Yeah. If I remember correctly, they operate similar to you as far as clinics, but I don't think they operate in the same segment of healthcare. So,
okay, so yeah, I see a diagnostic imaging. Yeah, so yeah, so I guess that what I would say is this. Yeah, okay, I see someone just posted teleradiology
there you
clinic.
go. Yeah.
Thank you, Paolo. So radiology is an interesting one. So one of our competitors expanded to radiology. It's definitely an adjacency that I didn't talk about earlier, but a fluoroscopy suite is an X-ray room, right?
Mhm.
You know, you know, what you do in fluoroscopy is real-time X-ray, which I mentioned. So there is definitely some synergy. Certainly, hiring those magical radiation techs that I mentioned earlier, those we would be competing with them on the rad tech side.
Yeah.
But in terms of what they would do as well is that some of the radiology groups do interventional pain. So they'll do all the radiology stuff, and then an interventional radiologist could also do, you know, interventional pain medicine. Whereas, you know, our fluoro suites, we've never really thought about doing diagnostic imaging. We just don't. So, you know, you can go you can go from where they are and enter our space, but it wouldn't be great for us to go that way. So yeah, no, it's an interesting one. There's definitely synergies with being in imaging. And the second thing is that if you have a spinal problem, you probably got an image before you went to see the doctor. So there's definitely that piece to it. It's capturing the pie, like we talked about earlier.
Yeah. Gotcha. Okay, so question from Adam. Why insiders only own 2%? It's only $200,000 worth of stock. Now, I kind of look at it a little bit different. 2% might be some of the key individuals, but Bloom Burton's a big shareholder as well. I think if you factor that in, the number's significantly higher. But maybe let's talk a little bit about that. You're not the founder of the company. You more or less parachuted in. What can you tell us about that? That's an insider holding a little bit more.
Sure. Yeah. No. So I mean, look, one, I own 500,000 shares that I bought in the market, not gifted, not optioned, that I bought with cash. I lent 140,000 to the company when we did our debenture deal 2 years ago. So I have put money into the business, even though I've only been running for 2 years. So I think that one of the challenges as a public co is always the challenge of endless blackout periods, and also being a non-founder. So I think that the idea here, I think it's very cute to selectively pick which board members you want to include in your insider piece, as you mentioned. Bloom Burton owns 32% of the company and is a board member and a shareholder, and a founding shareholder. I'm not a founding shareholder, and I bought 2% of the market. I bought at 85 cents. I bought at 35 cents. I bought again at 9 cents, and I bought again this week at 20 cents. So I've added to my position over time, and I expect to continue to do so.
Yeah, no, fantastic. Yeah, good. And then what are you most excited about in 2025?
Wow, what am I most excited about? Well, first, I would say I'm excited about a bunch of things. One, we added a new floor suite in Edmonton. We added 2 new floor suites in Mississauga. And the reason I like fluoroscopy is, one, we get to serve more patients. So these are usually for specialized procedures or more difficult procedures. So those are good. They're also higher margin procedures. So I like to add those and bring those on board. I'm really excited about some of the new PRP rollout that we're doing. So Ottawa had been doing it already. A few more doctors there have trained. We got some new equipment for them so they can do it more efficiently. We're now adding that in Oshawa and Brampton, so 2 of our busier clinics. So I think that I'm excited about some of these new procedures. Really would love to, in 2025, enter a new province. That would be a great thing for us to do.
And then thinking even longer term, where do you see this business in, say, 4 to 5 years? What would it look like?
Well, 4 to 5 years, we'd probably be in. I'd like to say we're at least 4 major provinces, and potentially beyond that. I'd like to see that we cover Ontario completely, and start adding some more adjacent services. I'd like to see orthopedics. I think orthopedics and chronic pain go hand in hand. I'd like to see doing a little more of that. I'd like to see more adjacent services being added. Like kind of where, instead of going to us for chronic pain, or for interventional pain medicine, you're going to us for the whole package, for all the pieces of the care. So that would be a perfect scenario where we have these multi-center clinics where you go across the hall to get your imaging, then you come in and see the doc, you get your procedure, then you go get some, you go see the nutritionist, you go see the sorry, I saw the question pop up. Yeah, so there's so you get to do the different aspects of the total care piece.
Yeah, gotcha. So as we get closer to wrap up here, from an investor standpoint here, where do you think are the either key metrics or maybe even catalysts to watch out for, let's say in the next year or so?
Well, I guess the one thing that we know and we control is our operations and our margins, and so keep looking for continued growth and margins, and adding new doctors and expanding our space. We think we're pretty excited going into 2025 where the business is at. Beyond that, I mean, you can never predict acquisitions, so we just try to always do that. It'll happen when it happens, and if it doesn't, it'll be maybe it'll be a greenfield. So we're always constantly assessing that, but I'd like to see an expansion outside of Ontario and Alberta in 2025. That's what I'd be most excited about.
And then, Joe, did we miss anything? Is there any questions I should have asked, or is there any key message you want to make sure everybody walks away with today?
No, I think that I guess the only key message is look, this is a great little business that I think probably is misunderstood and not known, and I'd love to just get people out there thinking about it and talking about it more. I mean, I think that everyone, if they think, right, one of the things I get from investors after they listen is their first thing is, can I send my mother-in-law there? Can I, my brother's really, can I, so there's this automatic, like, oh, my dad, and so everyone's got that thing. And so I think that this will spark a conversation probably around the table. I think people just, this is an important part of the system, and I think we're really happy to be part of it and help serve this very disadvantaged group. This is not a private medicine business overall. These are people who are in tough shape.
Yeah. It's interesting you said that, because my mother-in-law suffers from all sorts of back pain and leg pain, and it's exactly what I started thinking. Unfortunately, she lives in Vancouver Island, so it's too long to send her over to Edmonton. But no, listen, I appreciate this. I think it's been very helpful, and I agree with you. I think a lot of people are going to view the business and understand a little bit better. Certainly our network will understand it better thanks to your time with us here today. So, Joe, thanks a lot.
I just want to address that one last question, the hash to control pain. And so the short answer is we do not have marijuana or in any of our clinics. It's possible as part of their total care, the patient does. We don't have opioids in our clinics. We don't have any cannabis products in our clinics. Is it possible as part of their total care, the patient is, just as they go to see the physio, they may be prescribed some things that they're taking that help them. So I would be shocked if a bunch of our patients weren't getting cannabis products, but we don't we don't deliver them in our clinic. We're not providing that specifically to patients.
But I guess, but your doctors would prescribe other pain medications or other things that they're allowed to. Clearly, that's
part of that care package,
procedure.
or their GP, they're sending them in already on stuff, right? Because often what will happen is, because like I said, you cannot get into our clinic, by yourself. You need a referral, right?
Yeah.
These are specialist clinics, and so you need a referral. And so generally speaking, in Alberta, your physiotherapist can refer you, but in Ontario, generally it's a GP that has to refer you.
Gotcha. Excellent.
So it's kind of, so they may be on many things when they come in. Hopefully, if we help them, they can, take that down a little bit.
Yeah. Fantastic. Listen, Joe, thank you so much for your time today. This has been very helpful. I appreciate it. We've been speaking with Joe Walewicz, CEO of Neupath Health, symbol NPTH on the Venture Exchange. Listen, until we can catch up the next time, thank you and bye for now.
Thank you. Thanks, everyone.
Perfect. All right. Trev, you got all that?